FOMO, fear of missing out, gold stocks versus the gold price. The volume of emails and questions I get asking to buy specific gold or silver stocks is at the highest level in a long time. And it's coming from seasoned and new investors and subscribers alike. Be patient and always remember the quote from Charlie Munger. It takes character to sit with all that cash and do nothing. I didn't get to where I am by going after mediocre opportunities. Readers have been writing into the inbox in large volumes asking for gold and silver exposure. But the prudent and responsible thing to do is to wait for a pullback, which always comes. How sharp or long the pullback will be, no one knows. But it will happen. And you want to be prepared. Like Charlie Munger, I didn't get to where I am financially by chasing opportunities with the herd. Opportunities being touted by self-acclaimed gurus that have never actually been part of a real success, nor any experience on the successful discovery of a deposit or development of a mine on the corporation side are major warning signs to stay away from the popsicle stand gurus. Above all, I want to remind readers not to chase stocks. We've just seen the 8th largest dollar-wise pullback in gold history. We've stated this would happen. On a percentage-wise pullback, it's not even on the top 10 of pullbacks. Pullbacks are normal in all bull markets. The price of gold versus gold stocks. The chart you're looking at right now is something we've published in the past. It's a highlighted short-term resistance at 1750. If gold broke above that resistance, the extension target was 1850 to 1925. We've seen that. Gold blew straight through the extension target, then through $2,000 an ounce, and is now testing the $1,900 range again as of this recording. So what's next? It's very natural for the price of gold to consolidate and test the previous consolidation level. So far, gold could not hold above $2,000 for a week. Gold dropped $150 an ounce within 48 hours and is now flirting with the testing the 1800 handle. But even a correction to 1800 would not be considered unhealthy or unwarranted. It may not be what you want or what makes you feel good, but your desires are irrelevant. The sooner you control your own emotions, the better you become in both speculation and investing. One of the big questions every investor and speculator in precious metals is asking is this: why are gold stocks not performing as well as the metal itself? First of all, is that comment even true? Given the leverage the mining prices have to rising gold prices, one could believe that gold stocks should be higher. There are a few reasons gold equities have not responded according to expectations at $2,000 gold. First off, $2,000 gold didn't even last a month, so nobody was using $2,000 gold in their cash flows. Secondly, institutional investment in the gold sector drives large share purchases that bring prices up or down. The paper gold market, which consists of ETFs backed by gold, has seen billions of dollars of inflow, but the miners have not seen the same type of capital inflows. That means the big money is going for direct exposure to gold, not exposure via gold mining shares. Now, let's look into detail on what's going on. Institutional money and gold. To find out where the big institutional money is going, we start with the physical gold ETFs, which are the most liquid way for generalist funds to buy and sell for exposure to the gold sector. The chart you're looking at right now is the institutional fund flow for all of the physical ETFs, including the GLD, the IAU, and the GLDM. You'll see that there has been significant buying activity every week since mid-March 2020. Now, in the next chart, you'll see the institutional fund flow of all the major gold miner ETFs, including GDX and GDXJ. Note that the dollar volume units are 1/10 of those of the previous charts that we showed. What you'll see right away is that the money going into the gold miner ETFs is a mere fraction of the money going into gold ETFs. And the buying is all over the map when it comes to the gold miner ETFs. May 2020 saw the only solid streak of consecutive capital inflows in the gold miner ETFs. That's the chart you're looking at right now. The red lines mean capital outflows. The green lines mean net capital inflows. If you look at the cumulative fund flows side by side, the difference in investor appetite is incredible. The chart that you're looking at right now shows the cumulative fund flow for the paper market versus the gold miner sector ETF starting in January 2019. The gold line shows a net cumulative inflow of over $40 billion for exposure to the paper gold market versus a net capital outflow of negative 1.9 for the gold miners. So, since January 2019, the ETFs that provide exposure to gold miners have seen a net decrease in flow of funds. Meanwhile, ETFs that hold direct exposure to gold have added over 40 billion. So, how do the gold and silver stocks break out of their slump? Gold mining stocks have been hated by the generalist funds for a decade because so much wealth destruction happened in the last cycle. Let's look at the chart right now, the GDX between 2009 and 2014. Most of the generalist funds that came in got their asses handed to them. However, I do think that the last 7 months have been very constructive for the sector. The next chart shows the fund flow and share price for the GDX, which is a large and very liquid gold miner ETF. You'll see that in May, the total fund flow is over 1 billion, yet GDX barely moved. From June to today, in the yellow box you're looking at right now, the share price is up 20%, but the fund flow is negative. So what does this all mean? So you can see that the month of July, as gold broke 2,000, the red bars in the yellow box show flows of negative, indicating profit taking. That's the key. Since June, the fund flow is negative, but the share price is up 20%. We will see further consolidation and profit taking. However, if gold breaks 1750, we will see further exodus of funds. If we see gold consolidate its breakout above its old record highs, that should fuel new entrants into the space. If that happens and gold does not break the previous support levels, it will be on its next leg and going much higher. I am very bullish the price of gold over the next few years, but in the near term, we may see further consolidation. Gold could test the previous consolidation range of 1650 to 750 per ounce. If gold breaks down, it will be an incredible buying opportunity. We will send out an alert on what we will be doing with our own money to subscribers of Katusa Resource Opportunities. The last time we saw a major correction, I published a series of alerts with companies on my buy list that were hit. After that alert, the coming weeks saw multiple triple-digit returns. You have to be mentally prepared to take action and physically prepared with cash in your account for the opportunity. They say luck is being prepared when the opportunity arises. Being all in and not taking profits off the table and not taking Katusa free rides will leave you empty when it's time to hit the home run pitch. You must make your wins large and meaningful and your losses small and insignificant. Folks like Babe Ruth have used the home run mindset to achieve success for centuries. Professional gamblers have used it to clean out casinos. Top traders have used it to generate plus 100% annual returns. And the venture capitalists I mentioned earlier have used it to make billions in startups. Top performers fail as often as anyone, but top performers ensure their failures are small and limited, while their successes are large and meaningful. In fact, one of the companies in our portfolio of resource stocks jumped as much as 49% in a single day on the back of one of the most incredible drill holes of the year. And I'm working very hard on a pair of opportunities that I aim to have large and meaningful positions in my own personal portfolio. If you want to follow along and seize the best pitches as they cross home plate, become a member to Katusa Resource Opportunities. We're still in the early innings of something truly special. Stay safe.